Hey everyone, and welcome back to Inside the Portfolios with Hobart Wealth. I'm Jacob Woodrum, Director of Investment Strategy, and I've got a buddy with me today.
Hey, how's it going? Chris Hobart here, the CEO of Hobart Wealth, and we just thought we'd have a good time. The two of us with some special guests talking about the portfolio today, because this is one of my favorite portfolios. So I had to kind of butt in a little bit and share my thoughts.
We're excited to have Chris with us, and what we try to do in this series is give a look under the hood, not just at what we own, but really why we own it and how it fits into the overall financial picture. So today we're going to talk about something that honestly doesn't get enough attention in investing, and everyone might be surprised to hear what we're talking about, which is really taxes today. And you might say, well, how does that intertwine with investing? It's very important, and we'll get into it specifically because I think at the end of the day, and Chris, we talk about this all the time, it's what matters isn't what we earn in the market as much as what do we actually keep after taxes.
Well, and I think again we're going to dig into this, but I think that's the important thing that we really got to understand, which is so often we're worried about rate of return. The other person worried about rate of return is Uncle Sam. And if you can implement a strategy, kind of an overlay on top of good investment philosophy and strategy, and take advantage of some benefits within the tax code, right, or the structure that you're managing, it can make a world of difference, because now you're looking at rate of return after Uncle Sam's been worked out of the scenario, or at least minimized in the scenario.
Right. No, that's so true. And to help us walk through this, so we're joined by Sam and Jenny. So this is not Uncle Sam, right? This is Sam Shore.
A different Sam.
That's right. And they work very closely with our direct indexing and tax-aware investment solutions. So Sam and Jenny, we really appreciate you guys taking the time to be here with us today.
Thank you for having us.
So I want to start really simple. A lot of people, I think, hear terms like direct indexing or tax loss harvesting and immediately think that it sounds very complicated. So I think first question, if we had to explain direct indexing in the simplest way possible, what is it? How would we explain it?
Yeah, well, thanks for having us, Chris and Jacob. I think at a high level, the easiest way to explain direct indexing is to think about buying the individual pieces of an index rather than buying the whole puzzle in one box, if that makes sense. So you'll see kind of a graphical representation here, but instead of purchasing an index fund or an exchange traded fund that holds hundreds or sometimes even thousands of securities, you can buy a carefully selected sample of those stocks, and that is what direct indexing is, right? So this approach gives you the market exposure similar to that of a traditional fund, but with one key difference. You own the actual stocks. This ownership structure helps create some opportunities that simply aren't available with pooled investments like mutual funds and ETFs. The biggest opportunity, and you mentioned it, is managing your tax bill. So we'll discuss this more in detail in a minute, but this is by far the greatest feature of direct indexing. You can also personalize your portfolio. So your portfolio and your client's portfolio should really reflect their values. And through direct indexing, you can exclude companies or sectors that don't align with your beliefs while still maintaining kind of that broad market exposure. Also with direct indexing, you're able to have more control over your portfolio. You'll have visibility into every stock that you own. You'll know exactly what's in your portfolio and how each position is performing. And I think lastly, a key feature of direct indexing is the diversification of your holdings. So if you have a large position in one company or sector, direct indexing really can help you gradually diversify that portfolio without creating a massive tax bill.
And I love that concept that you just talked about, which is, a lot of times we have somebody come into the office, they might have a large position, and it's a matter of like, it's too much. And how do we introduce diversification in without creating some massive tax hit and do it strategically? And what you're talking about accomplishes that wonderfully for so many folks. Again, it's not an immediate like boom, you're done, but again, it's kind of like stepping into a cold pool or something. You know, you take your time, you take one step at a time to ease that tax burden and introduce that diversification.
Right.
I just love that. And I also the other thing is, you know, you talk about the ETF. You know, an ETF of the S&P 500 might have 500 stocks in there, but they're all in there, good and bad. And what you're talking about is, you know, when we're doing direct indexing, we can also remove some of the ones that we don't want in there. You know, just because it's inside of the S&P 500 doesn't mean we have to have it in there if it's not a good investment, which, as far as I can tell, that's kind of sound investing.
Yeah. You know, I also like too, Chris, your what we talk about, and sometimes I don't know that actually, and Jenny and Sam, you guys can, you know, chime in here too, but I don't know that we always talk about the tax benefits, and that's certainly a really important piece of this. But also, you know, the idea of investing with values, you know, kind of aligning with values, which is really, really impactful, and I think is a very very cool way to be able to, you know, to invest, you know, from a values perspective as well, which is
now real quick. Because when you talk values, sometimes when we talk, you're talking about a value stock.
Yeah.
Like, hey, this stock is considered a value. You're talking about like who you are. You know,
Right.
like you might have you know, religious beliefs, or you might not want to invest in tobacco companies,
Right.
and you can be strategic in that. And you can again, Jenny, as you'd mentioned, you can pull certain things out that you don't want to invest in. And I think that's the important thing. Most people have no clue, but if you're investing in a broad index, you likely are investing in some sort of a vice, or maybe something you don't support. And if investing with your values is important, you might not be able to be perfect, but you can remove a lot of things that you just may not want to support and may not want to financially benefit from or throw money to.
Right.
So
So next
Exactly.
question, maybe Sam, I'll send this one to you. You know, and we've talked a little bit about it, but in terms of owning the individual stocks, you know, rather than saying, oh, we're just going to buy this mutual fund or this ETF, you know, why does owning the individual stocks, again, kind of thinking about this from the perspective of don't really understand the strategy, the concept, why does owning the individual stocks matter from a tax perspective?
Yeah, so that's what really unlocks I'll call it the flexibility around taxes for your portfolio. So if you own a mutual fund and you want to take money out of your account, well, you have to sell a share of the mutual fund and you pay taxes on whatever the gain on that share was. You can't just sell your initial investment and not touch the gain, and vice versa. But with direct indexing, if you instead of having a single mutual fund that owns a number of stocks, if you just own the individual stocks, well, then you can pick and choose from not only the stocks, but the tax lots of the stocks that might be most advantageous and keep the tax bill as minimal as possible. And so you can either, in some cases, take cash out of your account and actually realize a net capital loss for tax purposes, or maybe it's a circumstance that we're able to only sell longer term lots for shorter terms. It's got to be advantageous, or just keep that minimal to begin with in terms of if there needs to be a gain taken.
you know, and this is a silly way to look at it, but I kind of look at it like, you know, you get that box of chocolate, you know, for Valentine's Day, and you know, you either have to eat all the pieces of chocolate because it's in the box, and even if it's something you hate, like let's say you hate coconut, but you got to eat coconut. That's your mutual fund or your ETF, right? Because you have to eat whatever's in that box. I'm one of those guys that I like to say, actually, I don't want to eat that, and I only want to eat this, this, and this. So it allows you to be a lot more selective, one, in choosing the stocks that you have, and then finding the benefits in there as well. Now, maybe chocolate's not the best thing, because maybe
I'll go for the dark chocolate.
maybe you'll go to the healthy option instead of chocolate. Maybe that's the thing. Hey, I don't even want to be in chocolate. I want to be eating carrots. That's you. That's you got to see how this guy eats every day for lunch. It's impressive.
You don't see what I eat at the
Yeah.
day, so no, that's a good way to explain it. I think, you know, maybe from the perspective too, just to pull on this thread a little bit further in terms of, you know, when we're talking about selling something at a loss, you know, tax loss harvesting, can you explain a little bit, in plain English, kind of what that means? And yeah, because we've had many conversations with folks where I think we explain the concept or we talk about it, and people are like, well, wait a second, you're telling me you're going to lose me money. It's like, no, tax loss harvesting, it's different, right? So maybe kind of let us know specifically what that means, tax loss harvesting, specifically.
Yeah, I think the important thing is you've got to remember there's sort of two components to when tax loss harvesting is done. So we have a stock in the portfolio that's at a loss, and we sell that stock. So let's say we have an energy stock at a loss, we sell it. Well, it's not as though then that cash is just sitting there not doing anything. That cash is then deployed into buying another stock. So it's not as though you're net losing any sort of exposure in your portfolio. You still have just as much money invested as stocks as before, but now for tax purposes, you have the capital loss from selling the first stock while still maintaining the potential for upside while owning the second stock. So really it's just sort of the full circle of, well, we have to sell something at a loss, but then we're also doing something with that cash. And I think a lot of times the focus is only on the first part of it, not the second part.
And I think what's important about that is I look at it like a bucket of losses, right? So basically, when inside of an ETF or inside of a mutual fund, there are going to be stocks that have a loss. If XYZ company is not doing well, most mutual funds are just going to just maintain that within the portfolio. But what you're doing is strategically saying, hey, we're going to cut this out because it's not performing, and we're going to take that loss and we're going to keep it for later because we can offset it against gains and clean up the portfolio to make the portfolio truly tax efficient. And that's what I like. I mean, if you think about it, you're simply saying, no matter what, not every investment is going to be perfect. So if we've got something that's not working, let's at least, let's make lemonade out of the lemon as much as possible. Let's take the loss, let's call it what it is, but let's offset the gains elsewhere. And all you're doing is still getting good performance on the portfolio, just minimizing the tax impact in the long term, which is what so many folks are missing right now. Is really they're investing, they've got the goods and the bad stocks, but they're not taking advantage of the tax piece inside. And that little piece of strategy right there can save. Again, I'm not sure if we can really talk without compliance getting after us, but I mean, that can have a pretty significant impact on what people actually put in their pocket or leave to heirs or everything in the long run.
Yeah, I think the thing that often gets left behind is it's not only what you save in year one, but if you're not paying that money to Uncle Sam, you're compounding on that money. So not only are you saving money in year one, but now you have more money in year 20 because of that savings in year one.
Mm-hmm. That is a good point, Sam. I was looking at a chart, just showing returns over time, exactly what you were talking about, which is, versus paying taxes, versus not having to pay taxes. And the difference in that over a longer period of time, 20 plus years, is tremendous.
Is that a chart that is able to be given to clients?
We might be able to share that. I probably still have to run it through compliance, obviously,
okay.
But yeah.
If anybody's interested in that, shoot Jacob an email, jacob@hobartwealth.com. Mm-hmm. And if we can get compliance approved, happy to show that that kind of impact of that tax benefit inside of there. I agree with you, though.
Well, I think, and one thing too that I think does surprise people is that these opportunities still exist specifically for loss harvesting, even when the overall market is positive, right? So, and maybe you guys can speak to that a little bit, because I've even this year I was looking at some information just last week where roughly speaking, like the S&P 500, 500 individual companies in the index, I think the numbers were roughly half positive, for the year, and half were actually negative, were down. And so, there's still, I think, the ability to still track the index, see returns when the index is positive, but still have the ability to look for those opportunities to loss harvest. Now, granted, they may not be as many as when the markets are down, but there's still opportunity, right?
Yeah, I think there's sort of two takeaways from there. One, you're certainly right. Even in up markets, I think we have a slide here with an illustration of that, that there is still a number of stocks that can be down. So you had mentioned the S&P 500. This is using the Russell 3000, so it's trying to do large caps, mid caps, and small caps, and looking at what was the performance of the market and what percentage of stocks of those 3,000 were down in a given year. So if we take last year, 2025, the market was up, I think it was 18, 19% roughly, and we still saw about 30% of the stocks in the market for the entire year actually posted a negative number. And so there are still opportunities even in those up years. The second thing is, even if we wound up the year up, that isn't how the whole year went. It would be really nice if our returns in a given year were just adding almost like a bank account, a little bit from January 1 to December 31. But anyone who's seen the market either this year or last year, it's a lot rockier than that. So in those midpoints during the year where the market may be down, there are greater loss harvesting opportunities in a down month than in 2 or 3 up months in a row. And so it's not just a question of, are we doing this once a year, but also I think the importance is doing it periodically so that we're able to take advantage of those differing market environments.
Mm-hmm. Yeah, it makes sense. Well, I think, you're saying this, Sam, I think we're all saying it, but owning the individual securities, does give us the ability to potentially offset taxes in ways that we just are not going to get, inside of that traditional ETF structure or a mutual fund. But one thing I'd love to get your all's perspective on, and we talked a little bit about this in preparation for our call today, which is, what do you think maybe are some of the things that people misunderstand the most about strategies like this? And I know we talked a little bit too about, how is, okay, we buy Apple and sell Microsoft. Well, why did we do that? What was kind of the reason for it with the strategy specifically?
Yeah, so whenever you're looking at a portfolio, and we hinted on this a little bit earlier when we were talking about, well, what if you have a concentrated position? We've got to look at what are all of the exposures in the portfolio. So what sectors are you invested in? What industry? What is the financial situation of those companies? How have they been performing? What are the relationships between those different companies? And so going back to when we loss harvest something, when we're looking to purchase something, well, we've got to purchase the things that most closely allow us to match what your benchmark for the account is, say the S&P 500. And so if the S&P 500 has 8% Apple, well, realistically, we can't have an account with 2% Apple. You will likely not perform very much like the overall index.
Yeah.
And so those things change, not just in terms of an individual's account, but also the exposures within the index change. If a stock doubles over the course of a year, well, we likely have to buy more of it if we were underweight that stock to begin with. And so we've got to take those considerations around how like the benchmark or the index is the account versus what are we looking to buy or sell in the account.
Yeah, that makes sense. I do think there's also maybe a little misunderstanding about this type of a strategy. Some people might look at it and say, oh, I'm not sure that this is, right for me, or if this, this makes the most sense, or can it add the value that I think it needs to add ultimately. But can you guys speak maybe a little bit about, generally who you see benefiting the most from this type of approach, and, where it fits best in terms of the strategy and, the tax benefit?
Yeah, I mean, I think based on our conversation so far, it obviously makes the most sense in taxable accounts and for clients in kind of higher tax brackets, right? So that will be where you see kind of the greatest benefits of a strategy like this. It's also, being pretty heavily used with clients today that are just looking for that customization and personalization that we've talked about too. Being able to have a portfolio that really reflects their values, like we talked about, being able to avoid certain companies that maybe they don't want to invest in. And so I think it's a really kind of a pair of those two clients that, again, have a longer term time horizon as well, that can really benefit from that customization and the tax loss harvesting. I think that will be where a strategy like this fits the best.
The other
Oh, go ahead, Sam.
I think the other thing that we mentioned a little bit earlier, I hate for us to lose sight of, is it's not solely a tax question. It can also be a a risk question. If you're a client who has a concentrated stock position that's highly appreciated, this can be a great fit. If you buy an ETF, if that ETF index includes the same stock, well, you're just getting more exposure to the concentrated stock you have. You're making the problem worse. Whereas via direct indexing, let's say you have a highly appreciated energy stock. Well, we're likely not going to buy a lot of energy stocks in your portfolio because you already have a position that gives us that exposure in the account to begin with.
Yeah, that is a good point. I do think it's easy sometimes for us to focus on solely the tax benefit, but not always remember too that there's a benefit. Certainly the tax is a very important point, but if we're also wanting to reduce exposure, in a particular company or stock we own, that can also really play into it as well. Sam and Jenny, really appreciate you guys taking the time to walk through this with us today. I think it was really incredibly helpful. We've really found a lot of value in using an approach like this for our clients. And again, we keep saying it, but the impact of we're going to grow your money over time, right? From a return perspective and investments and in the way that markets operate. But let's just make sure that, at the end of the day, that it's not going, all in the back door, right, to Uncle Sam. So hopefully for, those of you watching, this gives you a better understanding of not just what direct indexing and tax-aware investing are, but why we believe they really can play an important role, in the right situation. Because I think at the end of the day, investing, like I said, it's not only about what happens before taxes. We focus on that a lot at times, but it's really about what, actually ends up in our pockets, after taxes over time. And so this is just one of the ways that we try to build portfolios more thoughtfully, more intentionally for our clients. But as always, if you have any questions about how this type of strategy fits into your specific situation, we're always happy to walk through that with you. Thank you again for joining us, and we'll see you next time.